G'day. If you are running a business here in Australia, you know that managing your tax is every bit as crucial as making a sale. So today, we're diving into a really important financial strategy, one that can have a huge impact on your bottom line, franking credits, and that thing we all want to avoid, top-up tax.
But let's start with a bit of a puzzle. How on earth can a dividend paid out in July save you thousands of dollars in tax compared to the exact same dividend paid just 1 month earlier in June? I know, it sounds a bit strange, but it's absolutely true. And the answer? Well, that's a powerful strategy you're going to want to know.
So let's back up a bit. Why do we even have this whole franking credit system in the first place? Well, it all comes down to a problem the Aussie tax system is trying to fix: double taxation. Think about it. Your company makes a profit and it pays company tax on it. All good. But then when you pay that profit out to yourself as a dividend, suddenly it's your personal income and you get taxed on it again. Doesn't really seem fair, does it?
And that's exactly where our hero, the franking credit, steps in. Honestly, the easiest way to wrap your head around it is to think of it as a prepaid tax voucher. It's the government's way of saying, okay, we'll only tax that dollar of profit once. So what is a franking credit really? It's not actual cash, it's more like a receipt. It's proof that your company has already paid tax on the profits you're about to get. When the company pays you a dividend, it's like it's handing you this little voucher and saying, here you go, we've already taken care of some of the tax on this for you.
Okay, so here's how it plays out in the real world. Step 1. Your company makes a profit and pays its tax. Step 2. It decides to pay you a dividend from what's left over. Step 3. It attaches that franking credit, our prepaid voucher, to your dividend. And then step 4, when you do your personal tax return, you hand that voucher over to the ATO and it reduces the tax you owe. Simple, right?
Let's make this real with a quick example. This is Jenny. She gets a $700 dividend from her company. Attached to that is a $300 franking credit. Now, for tax purposes, she has to declare the whole thing as income. That's the $700 plus the $300, so $1,000. If her personal tax rate is 30%, she'd normally owe $300 in tax. But hang on, she's got that $300 prepaid voucher. She uses it, and boom, her final tax bill is zero. Zilch, the system worked perfectly.
But what happens when your personal tax rate isn't the same as the company's? This, my friends, is where we meet the star of our show, top-up tax, and it's pretty much what it sounds like. It's the extra bit of tax you have to pay to top up the difference between what the company already paid and what you owe at your personal rate.
And here's where the math kicks in. Let's say your company's tax rate was 25%, but you're in a higher tax bracket, say 39%. Well, the ATO wants that difference, which is 14%. That's your top-up tax. And if you're on the top marginal rate of 47%, that gap widens to a pretty chunky 22%. You can see how this can start to add up to some serious money. So this leads to the big question: how can we legally and smartly minimize this top-up tax? Well, it all boils down to one simple, powerful concept: timing. And the secret is hidden in a little quirk of the Australian financial year. Okay, listen up, because this is the golden rule. This is the key that unlocks the whole strategy. The franking rate your company can attach to a dividend is based on the tax rate it paid in the previous financial year, not the current year, the previous year. There's a 1-year lag. And this little detail, it creates a massive opportunity for smart business owners. Right, let's go back to that puzzle I set you at the beginning. Imagine a company that's been growing. Its tax rate has just jumped from 25% to 30%. In scenario A, they pay out a big dividend in June, right before the financial year ticks over. In scenario B, they just wait. They wait 1 more month and pay the exact same dividend in July. So what's the big deal? And here it is, the big aha moment. In June, because of that 1-year lag rule, the company can only attach a franking credit based on its old 25% tax rate. The shareholders' top-up tax bill is a whopping $44,000. But by just waiting until July, the company's franking rate officially updates to the new, higher 30% rate. It can attach a much bigger credit. And look, the top-up tax bill drops to just over $36,000. That's a saving of almost $8,000. And check out the bottom line. You also get to delay paying that tax for another whole year. That's a massive win for your cash flow.
Now, strategic timing is a fantastic tool to have in your kit, but there is a dark side we need to talk about, a trap that so many private company owners fall into, often without even realizing it. It's called Division 7A, and you absolutely need to know how to avoid it.
You know, it's a tempting thought, isn't it?
The company bank account is looking healthy, you've got a personal bill to pay. What's the harm in just zipping some money across or paying the bill directly from the business account? Well, the ATO has a very, very strict answer to that question.
This is the one principle you have to burn into your memory. Your company is not your personal piggy bank. It is a completely separate legal entity. Its money and its assets belong to the company, not to you personally. Even if you're the only shareholder, this rule is non-negotiable.
Look, there are clear, safe ways to get money out of your company. You can pay yourself a proper salary or director's fees. You can issue a formal, franked dividend, like we've been talking about. You can repay a loan that you previously made to the company. Or you can set up a formal, compliant loan from the company to you. Stick to these paths.
The wrong way is dangerously simple. Just taking the money. Paying for your personal groceries, your holiday, whatever, straight from the business account. If you do this, the ATO can decide that money is a deemed dividend. And trust me, it's the worst kind of dividend you can get. It is completely unfranked. The full amount is just dumped on top of your personal taxable income with zero credits to help soften the blow. It is a financially brutal mistake to make.
Okay, so we've covered the strategy for you and the huge risks to avoid. But it's worth just zooming out for a minute, because this whole system of franking credits is actually a subject of some pretty intense debate in Australia. Let's just take an impartial look at why.
The whole debate really gets heated around one specific feature that's pretty much unique to us. As this quote from the Australia Institute points out, we are the only country in the world that gives people cash refunds for unused franking credits. So, if your credits are worth more than the tax you owe, the ATO doesn't just wipe your bill, they'll actually send you a check for the difference.
Now, according to research from the Australian Institute, the benefits of this system aren't spread out evenly. Their findings show that the top 10% of income earners receive almost half of all the franking credits paid out. Meanwhile, the entire bottom 50% of income earners, they receive only about 10%. This distribution is right at the heart of the debate about whether the system is fair.
All right, let's boil all of that down. What are the key things you need to walk away with? Number 1, franking credits exist to stop profits being taxed twice. Number 2, and this is the big one for you, timing your dividends when your company's tax rate changes can save you a fortune and boost your cash flow. Number 3, never ever treat your company like a personal bank account, or the Division 7A monster will get you. And finally, remember that the whole system, especially those cash refunds, is a really hot topic of political debate.
Which really leaves us with one final question to ponder. Are franking credits a fair and powerful tool that helps business owners like you manage tax effectively? Or are they a loophole that mostly benefits the wealthy and is in desperate need of reform? There's no easy answer, but at least now you understand exactly how it all works. Thanks for tuning in.